Welcome. Today we have Camila Astaburuaga. She's a senior portfolio manager for EFGAM's New Capital Fixed Income Funds and is a member of the Fixed Income Asset Allocation team. She focuses on fixed income portfolio management, strategy, and training. She became a co-portfolio manager for both the New Capital Wealthy Nations Bond Fund and the New Capital Global Value Fund and co-manages a suite of fixed maturity projects. EFG Asset Management is the designated investment manager of Swiss banking group EFG International, and they manage the new capital funds and strategies and discretionary portfolios for clients worldwide. Their investment objective is to seek long-term appreciation through a combination of capital growth and income through investments in a broadly diversified range of debt securities issued by governments, institutions, and corporations in both developed and developing markets. And the funds actively manage and generally holds debt securities with investment-grade ratings and has no maturity limitations. Prior to joining the firm, Camila worked as a principal global investors where she held risk and fixed income research positions. She holds a BSc in finance and business administration from Universidad Católica de Chile, an investment management certificate, and is a CFA charter holder. So welcome, Camila. We're so excited. Thank you. I know it's late over there on a Friday night, so hopefully we can keep you engaged before you start your weekend. Before we get into investment ideas, let's step back and talk about your investment philosophy. What makes your strategy different from other investors?
Yeah, no, thanks, Nadine, and thanks for the opportunity to be here talking with you. So I feel like we're actually quite a fun asset manager because when we started, New Capital wasn't very well known. It was very small compared to, the big elephants in asset management. So we had to approach our way of doing things a bit different. We had to rethink if the way that it has been done is the correct way. So our approach is quite innovative, it's quite different, and it's based really in 3 pillars. The first one is that we believe that fixed income markets, although they're the largest market in the world, the largest asset class, is actually the most inefficient. The second pillar is that we believe that benchmarks in fixed income are bad. And the third thing that we believe is that more risk not necessarily means more reward. Okay. So what do we do with these 3 things? Is the first, I know, as I said, that fixed income, although it's the largest asset class, is supposed to be then the most efficient, but it's not, because every investor in fixed income has different objectives. Yeah. I mean, the most of the investors are actually central banks that couldn't care less about earning money. They care about providing liquidity to the market, or insurance companies. It's a lot more about matching their assets with their liabilities. So it's really up to asset managers to make money out of this asset class. But interestingly, most asset managers are based on benchmarks. Yeah. And in equity makes sense. The bigger the company, the bigger the weight on the benchmark. Perfect. But in fixed income, somebody, I don't know who, so that the bigger the debt, the bigger your weight in the benchmark, which doesn't make any sense. It's almost counterintuitive, because you end up having to invest in the companies and countries with more debt, which is exactly what you want to almost avoid. Mm-hmm. So our way was really to almost turn around the benchmarks, forget about who has the most or the less debt. It's about like your capacity to pay. Now we'll get a little bit more into that. But and the last thing, as I said, the pillar is more reward. More risk doesn't mean more reward. We have seen it time and time again. People think that yield is actually total return. It's not. Actually, things that with a lot higher yield not necessarily have better total return. So it's really about taking advantage of these inefficiencies of the market and being really agnostic on a benchmark base.
Well, it makes a lot of sense, right? If somebody's holding a lot of debt, I mean, it sounds reasonable to me. Companies who need a ton of debt, that's what we're seeing here, right? Companies that are loading up and needing credit from other banks, aren't necessarily the ones you want to be in. So I think that people didn't learn that lesson this week. Your strategy makes sense.
You think that they would, but they usually don't. And this has been happening all the time. And it has become even more risky now, because before you had a lot of debt in the system, but a lot of also capacity to pay that debt. Yeah. But since the global financial crisis, and especially in the last years with the very, very low interest rates, there has been an incentive for people, companies, banks, and sovereigns to actually increase their amount of debt. So it has become everything even more risky now. So more than ever, we think that this is very important.
Yeah. Yeah. When I was reading your materials, it looks like, we agree with you. It's the year to avoid major credit risk. So maybe you can talk a little bit about your view, investment grade versus high yield and other choices investors have today along the lines of what you're saying is, when you're looking at greater risk, greater return, how do you put that into context for 2023, knowing that maybe some of those risks are underestimated?
That's exactly the point. I don't like, it's not that I want to avoid risk.
Right.
Actually, I'm being paid a good fund manager. What they need to do is to take risk,
Yeah.
but I'm saying that I will only take risk if I'm being paid for it, because if not, otherwise, what's the point? So when people are very complacent, we have been seeing this in the past. If you even look at in Google Trends, like what are people concerned about, you see that in the past they were concerned about Russia, Ukraine,
Yeah.
or they were concerned about inflation, or they were concerned about geopolitical risks or COVID. And now you can see that people are worried about almost nothing, and that's when I get worried. When spreads are very very tight, your compensation to take extra risk is diminished. Then why take the risk? So I believe that although yields, they look attractive, and if you look at high yield,
Yeah.
like overall yields of 8% are really attractive. But do I actually think that the total return will be higher or lower than investment grade that is giving you a 6% total, a 6% yield? I actually think it will be lower, because I believe that spreads will widen a lot more in the high yield side when lower growth comes in and more defaults, and you can see that the liquidity in the market goes immediately in 1 second. In 2 days everything can change so much. So it's really but only if you're being paid for it, and I don't think that this year you're being paid to take extra risk in high yield.
Yeah. And that echoes some thoughts that we had from last year, and that you saw that high yield outperformed investment grade, right? And part of that was just maybe the longer duration of investment grade versus the shorter duration of high yield. So the rate game last year is what enabled, call it, typically higher risk, high yield to outperform. But when people start thinking about credit quality and duration becomes less of an issue, maybe because inflation's moderating or other reasons, the credit spreads will widen. I would guess, I would hope that that's how the world works. But I'd love to hear your thoughts on, how do investors thread that needle between last year when the paintbrush was painting everything with about duration, and when do we get to the point where people care about credit quality?
Yeah, no, completely agree. So as you said, high yield has a lower duration than investment grade, usually, if you look at all the benchmarks, etc. So and the although spreads widened last year, the true impact was duration, so interest rates. So of course the effect on investment grade was a lot larger than high yield, and also because high yield has a larger carry. So you would expect high yield to be able to absorb more of these changes in spread and interest rate.
Yeah.
And I do believe that it will happen. But now, when we look at different scenarios, in a hard landing scenario or in a soft landing scenario, the yield now that you're getting in investment grade is so large that actually, even if treasuries widen even 100 basis points more, you will be able then to absorb within that carry some of that. So for me, it would be very difficult to see a year with negative total returns this year, given the high yield that we started with this year. So for this year, I know, I see a lot of uncertainties in different parts of the market. It's not so much about like big defaults, but I do believe like local fundings are also deteriorating. People are still uncertain about growth. There's still a lot of like geopolitical things going around. So this year, I would much rather prefer taking a duration risk than credit risk.
Okay. And when you think about 2023 in terms of specific opportunities, whether it's like a theme that you're playing, which you just mentioned, right, or specific securities that get you most excited, are there regions of the world, are there certain kinds of companies, that you can talk about that get you more excited?
Yeah, I mean, To be honest, I know this must be awful because we're talking about people's investment and
Sure.
savings, and of course we have to take this very seriously. But it is a cliche, but for a reason, that when these uncertainties happen, opportunities also rise.
Yeah.
These dispersions in the markets, they create opportunities, and we are here to take those opportunities, especially because we're benchmark agnostic as well. So when you see the flows moving through ETFs, people have to sell the largest weights on the benchmarks, and we're here to do exactly the opposite. So this year I see several opportunities. As I was saying, I see more opportunities in investment grade versus high yield. Um, I do see opportunities in the financial market. I know, especially after Credit Suisse, there are some risks, of course, but I believe it's more like a confidence and liquidity risk crisis than actually a capital
Mhm.
or solvency crisis. So very different from the global financial crisis that we all still think about. Um, Also, different things. For example, the shape of the curve. I do believe that is still I do
Inverted.
believe that it will flatten. So you can,
Yeah.
yeah, exactly. It's too inverted. So I think that it could flatten a little bit. But more than anything, I would say, and that is very near, and it's not me trying to sell my fund in
Yeah, yeah, sure,
particular,
sure.
but yeah, exactly. It's We believe that in the past, what we have seen is that the countries have increased their debt, the indebtedness significantly, especially after COVID. Loads of countries, loads of sovereigns have a dual deficits, not only current account, but fiscal deficits. And when they have to start refinancing that debt that they got at almost 0% yield at very high levels, like now 6-7%, that would be very difficult. Those deficits will become even larger. So our way to approach this is to really go back to the basics and say, okay, we had to start everything again. How do you assess a risk in fixed income? And it's very simple. You have two ways of paying debt, really. It's the same when you go to a bank, for example, and you get a loan. The first thing that the bank asks you is, what's your salary? Because you can pay your debt with your salary. And that's like kind of the GDP of a country. But most importantly, also, the second question that they ask you is, what are your savings? What are your assets? Do you have a house that you can sell, or a car that you can sell to pay your debt, or your savings that you can take to actually pay your debt if you need? And that is very interesting because in fixed income, nobody looks at the asset part of countries, of the sovereigns. So by really going into that and looking at assets minus liabilities,
Uh-huh.
that's your net assets really, and especially looking at the foreign debt. So therefore, the foreign assets, you get to the true capital of a country, and you can rank then every country of the world by their net foreign assets, and you can truly see which countries have that flexibility. They don't need to refinance, or they don't need to come to external markets for their debt. They can actually support their own economies with their savings, versus those countries that are in a very bad situation, in the sense that they have to actually are very reliable on external markets to sustain their levels of debt. So we believe that there's an opportunity here because people are not pricing it that in yet.
So are you buying into the ones that can cover the debts, or are you looking to bet against those who can't cover their debts? What is the play that you're making?
Again, if I was being paid for the risk of going to those countries, maybe I would, but at the moment I'm not being paid. So I rather have, like, especially in fixed income, you have to remember that the risks are like the compensation is asymmetrical. I mean, you have a lot of potential downside with more or less expected
Set.
upside.
Yeah, yeah.
So what you really need to do from a risk management perspective, and also from a risk taking perspective, is to optimize your total return by decreasing your drawdown, your downside risk,
Sure.
really. So you can do that in two ways, and we do it actually in both ways. One is the top down, and the other one is the bottom up. So from a top down perspective, I rather much be in these very good countries that have high flexibility, that they don't need to refinance, or in the extreme, if there's a crisis, they don't need to raise so much their interest rates to attract capital, because that produces larger deficits and lower growth and even more downgrades. So just stay in those safe countries, because there are a lot of opportunities and good opportunities from a bottom-up perspective that give you the same yield than worse countries, but with a lot of lower drawdown. So,
So
like, if
are
you
there
want to
any
put it
countries
in,
that would surprise you people? Are there any countries that surprise people that you would say, oh, you should look into these countries because they're safer than you think?
yeah, exactly. I mean, people really love to put labels on things, and developed market is good, emerging market is bad. uh, I really believe that you should forget about that and look at the numbers, And for example, one of my favorite countries is Abu Dhabi. I mean, it's the Emirates,
Yes, sir.
the United Arab Emirates is
UAE,
such
yeah.
a good economy. It has tons of savings, low political risks. I mean, the
Yeah.
World Bank ranks it at a lower political risk than France, and definitely less than the UK. Not sure about the US though. um, but super stable GDP, quite diversified more than you think. If anything, has a negative correlation with oil prices.
Uh-huh.
So those type of things, you say, no, it's in the Middle East, it's risky, oil related. I don't want to touch it. A lot of a political risk, but then you have these unicorns or these gems that are hidden around that. And I think it happens with everything. It evolves, especially in emerging market. You put things in the same basket, like in the past, everybody was like, oh, all Latin should move the same. And then they realized that there were better countries than other ones. The same with Asia, the same in Middle East, the same in Africa. So it's to really go back to the fundamentals and see, where am I being paid for the risk.
And how do you define risk? As you were talking about before, you have kind of a set or more of a known upside with asymmetric downside. So obviously risk management is key to your process. So when you're thinking about, whether it's a government, fixed income or corporate or the like, what are you assessing in terms of risk? Is it just called permanent loss, or is it, downside from what you're expecting? How do you think about risk and baking that into what you do?
I mean, it's such a broad question, because of course, from a portfolio management perspective, you have a duration risk and credit risk. And of course, within credit risk, you have many different risks.
Yeah.
You have event risk, downgrade risk, you have financial risk, so
Risk.
like leverage or, liquidity risk as well. But I believe that again, well, ESG risk is one that is being very popular at the moment, and for a reason. It's I think that everybody has always looked at it in the past, but now they put more like a name to it, and a
Sure.
framework to analyze it better. But I believe, as I said, more than just avoiding the risk is really clearly stating, what am I being paid for. So I'll give you an example. So I was looking now at opportunities, because people, when they panic, they sell stuff, and especially
Yes.
they sell good stuff, because they sell the things that they can actually sell, not the things that
Right.
they
Right.
lose
Right.
really
They get
fast.
more value for, right? They don't want to take a huge
Exactly,
loss. They
exactly.
have a little loss, right?
Exactly. And that's why I was saying, I mean, although it's cliche, like, these opportunities arise, especially in this kind of market. So you have to be very, fast to know exactly what you're looking for. So for A-rated bonds with the same duration, with the same rating, and more or less, not in the same sector, but corporate versus financials, let's
Sure.
put it like that, you are seeing big dispersion. So bonds are trading at 50 basis points, bonds with the same characteristics really trading at 200 basis points. So why is that difference? If the rating agencies are really doing correct analysis of the risks, there shouldn't be that difference. So some difference will be created by technicals, and those are like the true inefficiencies that we can take advantage. But other inefficiencies are being because people are overreacting to negative news, or because the rating agencies are not doing their work correctly. So you have to really understand what is driving spreads change. So now is a example. People don't want to touch European banks, like, no matter what. They just want to sell. They want to get out of it. And you have to really differentiate, not only between senior, subordinated funds, but even in the senior level, if it's the holdco or is the
Yeah.
opco, and if they have any triggers in the AT1s as well. You have a CET1s triggers, or at a very low level, so other ones at big levels, which banks are more capitalized or not. So again, it's really understanding what risks you're taking more than anything.
And this is more of it's personal and professional, but when you look back, you've obviously been doing this a while. What is one of the greatest lessons of your career that you can share with people?
That's a good question. I feel like I would say that especially after a while, I think that when something, in your gut when something is good or value, but you really have to have a very strong and disciplined investment process, because sometimes you get in love with ideas, but then you don't know when to exit. So anytime that you go into something, I believe it's very important to also have like an exit strategy. When does it become not cheap enough to hold it? So to continue finding these opportunities, because if not, you get too complacent, and that's when things really slap on your face with the risks. So keep an understanding of, again, I know I've said it many times, but not only where the risks are, but if you're being compensated for them.
You're compensated for them. That's it's a good point, right? We all find that complacency at some point, and then you look back and said, like, I knew better. I should have exited or trimmed or whatever the action was. Yeah,
I know, hindsight, huh? And I would say that just the other thing I would be is like, have a good team. Someone that thinks differently than you, a bit outside the box, that can really debate your ideas. Because if you just have a yes man around, or yes woman, I don't know, I'm not very millennial talking like that, but it's really good to have that constant debate between your team.
And so last but not least, how can people find you, Camila, either to keep abreast of what you're doing or to get in touch?
So we have our website is called New Capital. So there you can find all our New Capital funds. We have fixed income, equity, alternatives, etc. I'm also sometimes in Twitter talking about different things, conferences. But you can definitely share my email if you want. I know my last name is so difficult. That.
But I hope I got it. Did I get it?
You got it actually really good. It's my husband's last name is Taylor, and everybody was like, please change your last name to Taylor. I'm like, no, I'm keeping mine. But my email is camila.astaburuaga@efgam.com. So you can also, find me there.
Well, awesome. Thank you so much for sharing your time and insights with everyone today. We really appreciate it.
Yeah, no, thank you. Thanks for doing this.